Welcome to Everyday Economics, a podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, president of the 501c3 nonprofit Franklin News Foundation. Everyday Economics is a production of America's Talking Network. You can check out all of our great podcasts at americastalking.com. To support podcasts such as this one, please make your tax-deductible charitable contribution by clicking the link in the show description. We are recording this episode on Tuesday, December 13th. And joining me, as always, is my partner, Dr. Orphe Divounguy. He's a PhD economist. Oh, we got big news that is literally breaking. I mean, we're taping this at 9:11 in the morning, Central Time. You're on Pacific Time, 7:11 a.m. Pacific Time. The November inflation report is out, and the data is interesting. Price gains, they slowed more than some economists had thought, 7.1% in November. So, and that's down from a peak of, what was it? We're just 8.6.
Yeah, we were past the 8-point mark. We were closer to 9%. I mean, you know, the peak, we hit the peak in June, and headline inflation's been declining since. And this is great news, man. I mean, I'm extremely happy to see this. You know?
Tell me and the good folks in the Everyday Economics audience why they should care about this.
Inflation being too high is a threat to sustainable economic growth, right? And here's why. You know, if the pace of price increases continues to grow faster than incomes, to move faster than incomes, then there's a real risk that households could run out of their savings. And then we could worry about that deep contraction. Consumers make up 70% of GDP. If we have a problem and households are not out there spending because they just can't spend anymore, we could get that deep contraction that everybody had been worried about or warning about.
The last 3 years have really been an economic disaster, one that we will remember for a long time. And what you're saying is this could be an even greater disaster if there wasn't as much savings available to the average American.
That's right. And you know, a lot of Americans, especially those at the bottom of the income distribution, low-income Americans have already run out of room.
Right. Absolutely. When I say average, maybe that's not the right term. Maybe it's slightly above average, because without a doubt, there are people that are running on fumes at this point.
Exactly. You know, when you have the price of eggs going up 40% year over year, you know, you're squeezing families so much. And so it was important. It's absolutely necessary for inflation to continue to come down in order to give some families a little bit of breathing room. You know, look, demand far outpaced supply. And what the Fed is doing is trying to realign demand with supply in order to reduce the risk that we end up in that deep contraction that everyone's been warning about. So this is good news. Of course, prices are still way too high, and price increases are still way too high, even at 7.1%.
One area I wanted to talk to you about specifically inside of the data from today. Okay, so this story is breaking in the news cycle today, is rent. That is one of the areas that seems to be really kind of hanging in there. Look, the work that you're doing now, the focus that you have on the housing industry is pretty specific. But I think you made a good point, a conversation that you and I had, maybe it was Sunday morning when you and I had a chance to talk. People need a place to live. It's a fundamental part of human survival. And it's like, okay, so let's talk about it in those terms. Why is rent being so, steadfast?
So it's just the way the CPI measures rent. You know, if you look at market rents have actually come down. They've come down for 2 consecutive months. They came down in October. They came down in November on a monthly basis. Year over year, rent growth has been coming down since the month of March. They're coming down. They're coming down because you have a supply side effect of more landlords coming on the market. You also have renters in facing all this uncertainty, choosing not to move as much. So if people move less, you know, the people who do move are the ones seeing more rapid rent increases.
Are you seeing anything, like one of the anecdotal stories that seemed to be really picking up steam earlier this year was people who were coming out of leases, their leases were expiring. They didn't necessarily want to move, but they were getting new rents from their landlords, and landlords were reasonably so adjusting their rates to market values. In some cases, you know, in some of the hotter markets around the country, this meant a big increase, like maybe going from, say, like $1,800 a month to $2,500 a month just to stay in the same property. Are we seeing that now?
Because home values have come down substantially since they were high over the summer, since they peaked during the summer, rents are expected to follow. And that's exactly what we're seeing. Home prices have come down in some of the hottest markets, and rents are going down as well, And so I think we're going to see this materialize in the CPI numbers sometime in 2023, because all of the research, some research even done by the Fed does not ignore market rents. The Fed actually tracks this stuff. They know that the Zillow Observed Rent Index actually leads the rent in CPI, in the Consumer Price Index, by roughly a year or so. And so if that typical relationship holds, we should see shelter inflation decline substantially in 2023.
So I have a question. Obviously, we're trying to stay contemporary to the news and deliver it as quickly as we can. It's a busy week. CPI came out today, Tuesday. Tomorrow, Wednesday, December 14th, we are going to hear from the Fed. So we have about a minute left. What do you think the Fed is going to do next?
I think the Fed is going to stay the course. I mean, we heard from Chairman Powell a week ago, I believe now, about the fact that inflation has to come down, and they're probably going to slow down the magnitude of these rate increases. And I think the reason for that is policy error, right? They don't want to tighten too much. And so it's clear that more needs to be done, but that we're likely not going to see, another 75 basis point increase in the Fed funds rate in the December meeting.
We would think that the market will find this all to be very, very good news.
Oh, I'm sure. And, it's all priced in. People expect it to happen. And so, the market will be happy to see that. Remember, the inflation news is the bigger news.
For sure.
The Fed only responds to the fresh economic data coming in. If inflation is expected to come down, then borrowing costs are going to fall. Long-term borrowing costs are going to start to fall. And so that's what happens. And so the Fed is responding to the economic news with, its policy. And so, this is the big news. This is the news markets respond to. It's, expectations over where the economy is going to be in the future, where inflation is going to be going forward. So this is a great way to end 2023 with, inflation having peaked, and knowing that, there is light at the end of the tunnel.
For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics and dozens of other quality podcasts at americastalking.com.